All right, so starters. My schedule's still screwed up on this thing because actually the finals week doesn't end until the 16th of December. For some reason, I thought it'd be the 9th of December, but it's the 16th of December. Okay, so the whole content and everything is kind of goofed up. It's okay, I'm going to change it. You got a quiz right now that's due on Thanksgiving. I'll change that to the next week and then put the stuff in the other week following that so that you kind of have a few things to do, quizzes to do those last couple of weeks. But your assignments go away, those last couple of weeks too, because we run out of problems really in terms of what the textbook had and whatnot. Again, I'll probably talk about some general things there, and you've got a quiz, and I may quiz you even in, we may talk about, and I may quiz you about some of those things in class a little bit just for the heck of it, okay? Partly because there's a lot going on in the world right now with inflation and everything. What did the Fed do yesterday with rates? They go inward, yeah, yeah. That's a sure sign of recession, but what they did yesterday, the Federal Reserve met and they raised interest rates again. They raised the Fed funds rate, it's called, by 0.75%. That's the fourth time in a row that they've raised it by 0.75%, which is a little bit unusual. Prior to that, they had raised it by 0.5% and 0.25%. So technically, we've had about 5.75 increases in the interest rate over the last, say, 6 or 8 months. That's a lot. Okay, interest rates have really, really gone up. Okay, and that's a little bit frightening for a couple things. Just the government debt itself. Think about that. Government's got $30 trillion in debt. Now all of a sudden they're going to be paying about 5% more on 30 trillion. Yeah, my math's a little bit slow, but is that like about 1.5 trillion additional dollars in just interest payments? So that's frightening, but also thinking, I think of my old days as a banker and the farmers. I mean, last year they were paying, 4 or 5, 6% maybe for their operating lines, and this year they're going to be paying 9, 10%. Okay, the Fed funds rate, by the way, so is really just the rate that the Federal Reserve charges to banks if banks need to borrow money on a short-term basis. Okay, that almost doesn't happen very often. Banks don't usually borrow a lot of money on a short-term basis from the Federal Reserve. They've got plenty of deposits and whatnot. Most banks have way more deposits. So it really doesn't have a lot of effect other than it's just a signal by the Federal Reserve that interest rates need to go up, basically. And so they do, okay? And prime rate, I'd have to look that up, but prime rate's probably at 6% now, maybe 5, 6%, somewhere in that neighborhood. Um, wow. Yeah. Well, it's crazy. Yeah. Yeah. And it was, 2 years ago, that same rate was 3%. So, 6% difference on 300 grand. Again, I'm not real good at math, but that's about 18,000 bucks, a year. I mean, that's a ton of extra money that you got to pay for those types of things. Those are the same things that are coming up for businesses, right? I will always say, and I'll still say this, debt's cheaper than equity, but right now that gap is narrowing, okay? The gap is definitely getting more and more narrow. Debt's always cheaper than equity, okay? But the gap is getting narrower. Um, Registration's open. You guys that need to register for next semester, get after that a little bit. Athletes, by the way, you guys have to do a written form, okay? Okay, good. And I know for business students, with Lanny being out and everything, Laura's kind of overbooked. So if anybody needs any help with registration, you want to come see me, just let me know. I'm happy to sit down with you and do that. I can still sign even though I'm only part-time and whatnot. I can still sign. I can be an advisor. I can do all of that. So if anybody wants to do that, if you find that your assigned advisor is a little too busy or something or inaccessible, feel free to hit me up. I'm happy to help out in that regard, help Laura out a little bit, and Lanny too. So Lanny's kind of back. He's supposed to start working again a little bit on operations management class, so you'll, oh, I know, I
This is
told,
what I just wanted to come back to.
I warned him that. I talked to him a week or so ago when I was on vacation, and I said, you don't want to start up when I get back because everything's going to be built up, all these assignments and everything. And of course, he assigns so much stuff. Holy cow.
An insane amount of stuff.
Yeah.
And why
But,
would you want to grade that
yeah.
anyway? It's his own sense cost
Mhm.
structure.
I think he's a little anxious to get back to doing something, though, if that makes some sense. He's been out, and I think he's a little anxious. So I couldn't talk him out of, letting me, run with it for another week or two and try to get caught back up, but, oh well, hopefully it all works out good, knock on wood, but I'm hoping that means Lanny's feeling better and getting back at it, so. Okay, then, any questions about that? I know you got some specific questions about 13, but I'll come and take a look at that with you and whatnot. I wanted to look at then, let's take a look at just a specific company, one of your guys's. And I'll do this probably the rest of the semester. I'll pick your guys' companies, take a look at them, I'll call them up, we'll see what's going on. I'll give you some hints about some of the things I would look for. Mostly, I'm not gonna pull up the annual reports, okay? So mostly I'm gonna say, well, we'll see here. Let me just get into it and then we'll go. So, Seeking Alpha, I do like this site. So I'm gonna pick on Bridger's company. Because he and I were kind of talking about this a little bit Tuesday, and I took a look at it, and I saw some things, that's kind of cool. Okay, this company's been doing really well. I mean, I'd start my analysis, kind of on the assumption that this company's really been doing pretty darn well. Again, here's a chart of its stock prices. That's nice, I don't care a whit about the stock prices, right? Okay. I will say this, you can sometimes click on a lot of these sites and you'll find professional analysis of these companies, okay? I have read professional analysis of companies for the last 30 years. I enjoy reading them and whatnot. If you copy and paste that stuff into your paper, I will recognize it immediately because they speak their own language and they use their own terminology, and I'll recognize it immediately. I'll copy and paste that into a search engine and I'll discover where you got it from. So, that's not to say that you shouldn't read those things and do it, but you need to read it and then decipher it yourself and, put things in your own words, okay? So, reference it, yeah. Yeah, there's nothing wrong with putting a quote in there. If somebody makes a good quote about something and you like that, from the annual report especially, put it in quotes. And that's a reminder too, as you're writing this, I expect you to cite sources, okay? But I'm not terribly concerned about the format. There's ALA and MLA and APA or something like that, right? Okay, I'm not terribly concerned about that. As far as I'm concerned, you can even cite it within the text. So if you want to say that you just wrote a paragraph and you got most of that information from the annual report from 2020, that's fine. End of the paragraph, annual report 2020 or something like that's fine. Okay, so this isn't a class that's a hardcore English class. I do correct for grammar, I do correct for spelling, I do correct for all those things, I will, but I'm not that hardcore when it comes to, the bibliography, I guess, or citing the sources and whatnot. So Seeking Alpha, and sometimes, I like to look at this a little bit differently. For one, I'm going to, latest on the left, it doesn't really matter, okay? So I look at Decker and my first thing, God, look at its sales, from 2018 to 2022, and they've got a year end that's March, okay, we know that from this up here. Remember, corporations can have different year ends. So, I mean, it's gone from 1.9, I'm guessing this is billion, to 3.1, and the trailing 12 months is even better, so they continue to show really strong growth. It's not quite doubling in 5 years, but that's pretty strong growth. That's about a 10% annual growth rate, which is pretty good, even during the pandemic. And in fact, geez, the pandemic might not have been bad for them at all. It might have been good. Yeah, and Bridger and I talked a little bit about that, people wanted to get outdoors, right? You might have been cooped up for a month or two, and then you said, "Hell with that, give me a tent, I'm gonna go camping," or people can't yell at me or whatever. Gross profit, kind of the same, okay? Now here's where this is what I really like about this, because I like to come up here sometimes and look at it like this, right? So their cost of sales have gone from 51 down to 49. Again, that doesn't sound like a lot, but 2% on, $3.5 billion that's not pocket change, okay? And so those things really matter, and I just love that I can toggle back and forth and kind of look at it in that fashion. I could calculate that easily myself, right? That wouldn't be any problem, but this does it for you, so why not take advantage of that, okay? Same thing with selling and general administrative expenses. Now, while my sales have not quite doubled, they've gone up 90%, something like that, it almost looks like my selling and general admin expenses, and even all the way down here, my total operating expenses, they haven't increased nearly as much, and I want to take a look at that. Let's see. So they've gone from 37% down to 33%. So not only are my gross margins increasing up here on the top, right? My gross profit's gone from 49 up to 51, but my operating expenses have gone from 37 down to 33. I mean, those are two really, really good trends, and I see that right here when I look at my operating income, and I'm rounding things as I talk here, I'm sorry, and when you write, you probably should maybe not round quite as much as how I'm speaking. But I've gone from 12% to 18%. So I've increased my operating income by 6 percentage points. And make sure you use that properly. It's 6 percentage points. If you said you increased it by 6%, that would be incorrect. I've increased it by 6 percentage points. Okay? 6 percentage points on, what did we say, it's 3.1 billion? Oops, sorry. Yeah, they're almost up to 3.5 billion now, right? Okay, so 6% on that, again, is not pocket change. That's quite a bit of money, okay? I come down, they don't have a lot going on down here, okay? I mean, interest, they got a little interest expense, sure, they're probably got a little operating loan here or there. They actually have an interest and investment income, okay? And so their net is practically zero, okay? And I'm not going to write a lot about that other than maybe to say that their net interest is practically zero, right? And has been really for the last 5 years, okay? It means they don't have a lot of debt. They don't have a ton of other investments and whatnot. A little bit of other, some of you, the rest of you need to really look at this because your companies may have big numbers here. We don't know, right? If they got debt, big debt, they might have a lot of numbers going on up here, interest expense and whatnot that they're paying, right? Okay. And then, so their earnings before taxes, and we would expect, I mean, geez, their sales have almost doubled and their expenses have gone down and their gross profit's gone up. What do I think has happened with their profits? Earnings before taxes have gone from 220, so it has way more than doubled. Way more than doubled, right? We've gone from 220 to 564. We do have income tax expense. That's kind of weird how it was so high then, and then look how far down it dropped. What do you suppose happened there? Their income and everything was up. Why would their taxes have gone down? Is that when the tax reduction took effect? Probably was. So we might have to go back and take a look at that, right? So we might have to take a look at this year's annual report and say, the income tax reduction that happened in 20, should have taken place, I think, in 2018, somewhere in that neighborhood, right? I don't remember for sure, okay? But I would guess that that's what happened in that space. And so look at their income, earnings from continuing operations, 4 times. I mean, this is pretty good, really good stuff, okay? Then, of course, you can come down here and you get the earnings per share, which are also very nice to look at. Again, 360 up to 1643. You will see diluted earnings per share, and I kind of explained to you a little bit. We're not seeing a ton of difference here. What's that mean? That means that Decker probably does have a little bit of compensation, stock compensation and whatnot, stock options that they're giving to some of their employees, probably their CEO, maybe only their CEO, okay? kind of guessing there, but the fact that there's very little difference there. If you're looking at yours and there's a big difference between the earnings, basic earnings per share and the diluted earnings per share, almost always that's going to be in stock-based compensation, that they're stock options compensation that they're giving to employees. Some companies aggressively do that even with lower level employees. Okay, a lot of companies do it just for maybe the upper management, very upper management, but some companies will do that way down. Okay. So diluted earnings per share, diluted weighted average shares outstanding. This is a little bit interesting too. So they've gone from 32, I'm guessing this is 32 million, down to 27, almost 28 million. So what's happening there? Yeah. So in addition to everything else that's going on good with this company, they're buying back stock. And so if I've been a shareholder, my share of that company has actually, my share of ownership in that company has actually increased if I didn't sell my stock. And that's one of the reasons the earnings per share take such a great, leap.
But doesn't that's why we think of debt divided with equity, because that's their stock that increases their equity for more of their own company.
No, it's their equity, the equity on their balance sheet is actually decreasing. Okay, they're expending cash, so they're spending an asset, right? And they're decreasing the equity portion on their balance sheet. We'll see that. We'll probably see that when we look at the balance sheet. So, okay. If you think of the accounting equation, if cash goes, what has to decrease? Either liabilities or equity, right? One of those two, and it's not liabilities. So if you're buying back stock, you're decreasing your equity. Okay, has to. You're thinking of the
I've given the company $1,000 of my money on as a loan.
right.
I own
No,
part of their company.
no, that's not a loan. You own the company. The company doesn't own itself. You own the company.
So now they're buying me out.
No, you're looking at it wrong. The company doesn't own itself. The company's owned by other people, huh? It's a public company. It's owned by you and me and everybody else.
Well, so is Twitter, but not anymore.
No, Twitter just became a privately owned company.
Single Click bought the entire thing. So all the stock
Yep.
from, and he owns it in its entirety. He was the head dude, he owns it.
That happens with companies. That happened with Dell.
That's my point though. Put out all of the, also they sold the stocks to get the money, that's,
Twitter didn't get any money out of that. Twitter got zero money.
I'm
Right.
not talking about it.
Right. Well, you can't think of companies as owning themselves. Companies don't own themselves. They are owned by people. Okay.
Less shares outstanding than that.
It should. Yeah. It should. Yep. Yep. Assuming that the value of the company stays the same, and normally the value of a company is based on its future earnings, right? Okay. There's, anytime you take cash, though, you're also decreasing the balance sheet. You're increasing the asset part of the balance sheet, so you're decreasing the equity part of the balance sheet. And so in essence, when you're buying back stock, the book value of the shareholder goes down. Okay, the book value does, but it doesn't necessarily affect the market value. And we got to keep that in mind, that there's those two different concepts. There's market value and there's book value. And I'll try to show you that when we look at Decker here as we go and look at the balance sheet. We get down here to these normalized basic earnings per shares and normalized. I'm not 100% sure what that means. We'd have to go take a look at it. Okay. Why they would normalize that. I think that probably has to do with the difference between SEC reporting and IRS reporting. Okay, I'd have to look at that and tell you for sure, but you pay your taxes on what you've actually earned, okay? But when you report to the SEC and what they report to us, the stuff that we look at typically, is different. The SEC has some different requirements than the IRS, and so oftentimes there's a difference in those numbers. And I'm betting that that's what that is. We see here, okay, effective tax rate, it was 48.2%, and it went down to under 20%. Tax law change. That was a tax, yeah. Trump really pushed hard to get taxes reduced, especially for corporations and whatnot, but also for individuals too. The tax rates, the top tax rates came down. Okay, it's not always though a phenomenon that's because of U.S. taxes. If a company does a lot of business overseas and whatnot too, it could be affected by overseas taxes. Maybe they quit doing business in a really high tax jurisdiction, and so their tax rates went down too. So there could be other factors that are involved in that. But I would guess, very strongly that the major factor there was the reduction that we had in. Right. Yeah. Yeah. Same. Yeah. Basically the same thing. Again, here, because their year ends March, I'm not sure what Procter & Gamble's year end is, but June, yeah. But that could be why yours is showing up then versus, yeah, okay. Okay, so that's the income statement we've looked at. Then we can come here and look at the balance sheet. And again, sometimes, we maybe flop a little bit. I got it on the left. Cash and equivalents, they've had a nice little increase in cash, but that's probably to be expected with the growth of the company, right? I mean, the company's been growing. We're probably going to accumulate a little bit more cash on hand. I get that. They did, had a big jump up there, and they've kind of dropped down a little bit there. They might have spent some of that cash on buying back the stock too, right? That could be. We can probably see when we get down a little bit below. Accounts receivable gone up a little bit, pretty much in line with the growth in the company. Again, that would be totally expected. I don't see anything here that really jumps out at me, right? Their sales doubled, and or nearly doubled, and their accounts receivable nearly doubled. Oh, gee, that's probably what should happen. Same thing, inventory, right? Guess what? Your sales nearly doubled, your inventory nearly doubles, okay? So I don't see a whole lot going up here. Again, total current assets have pretty much doubled, and again, pretty much in line with the growth in the company, right? Gross property, plant, and equipment, okay, this is things, and for a retailer like them, you wouldn't expect them to have a ton of gross property, plant, and equipment. They probably lease most of their locations and whatnot. They probably have some warehouses and maybe some transportation things and stuff like that, okay? And that kind of makes sense. And, they've been able, here again, they've been able to grow the company without increasing this as rapidly. That's kind of a plus, right? Net, yeah, that has almost doubled because of the depreciation that's going on. Goodwill stayed the same. What if you saw a big jump in goodwill? What might that mean? Okay. Some of you may see that in some of your financial statements, and we'll probably see that as we're looking at some. Generally, what goodwill is, when you buy a company, okay, and this would be the Elon Musk thing, okay, a company has a book value, right? And I've told you often the book value differs from the market value, and I'll show you that with Deckard here in a little bit, okay? So the difference between that book value, this is a real simplistic way to look at it, but this is basically it. The difference between that book value and the market value is called goodwill, okay? The difference between those is, yeah. I mean, there's just a lot of companies that have, they make a lot of money, but they don't necessarily have a lot of physical assets, right? And so, Twitter would be one of those. What's Twitter need to operate? They got one little office building, a few, what do they have, a couple thousand employees, soon to be about half that number from the things I read, okay? I mean, I'll bet you his goodwill that he books on that is going to be huge, okay? He'll be able to write some of that off. They're in the position here where they're not writing any of their goodwill off, okay? Other intangibles, you might take a look at those. I don't see anything there. It looks like something that maybe they're amortizing a little bit. Again, it's not a huge number for this, for this company. Deferred taxes, deferred tax assets. This I can tell you, some of you may find some huge changes in this, and this gets to be, it would take me a semester to try to explain it, because it took me a semester to try to figure it out. But when the tax laws change, there's not much going on, thank God, with Decker. This happens with a lot of like automobile manufacturers, heavy equipment, airplanes, those types of things. But when the tax law changed, it just has to do with, again, the difference between the IRS reporting and the SEC reporting. Anybody wants to know that, when you see it on yours, if you want me to explain it further, I will. But yeah, I'm going to kind of leave it there, because it does get to be a little bit complicated and it gets to be a little confusing. Accounts payable, they've increased quite a bit more, than the growth in the company, probably because they're buying more inventory, they're doing those types of things. And their suppliers are, based on how the company's doing, is more than willing to allow them to do that. So current liabilities have actually, if you look at everything, yeah, they've gone up quite a bit. Most of that's in the accounts payable, right? So we might want to take a look at that and just say, our accounts payable really increased. We've seen some pretty good bumps here to here and then here to here. Some pretty good bumps in accounts payable. You might read about that in the annual report and see what's going on. Long-term debt, gosh, look at that, went from there down to nothing. But what happened here? Capital leases. All of a sudden, we paid off all our long-term debt. So this company has zero long-term debt. But all of a sudden, we've entered into these capital leases. And what's going on there? Okay. Again, this has to do a little bit with SEC requirements versus IRS requirements. But yeah, they've entered into some long-term leases probably. And so they've got to book that as an obligation, right? Now, as far as the IRS is concerned, that doesn't become an obligation until you actually pay your lease payment, right? Then it's an expense that you can write off. But as far as the SEC is concerned, I think this is what's going on. I'm just looking at this without looking at the annual report. As far as the SEC is concerned, you've entered into an agreement that you're going to pay these leases over a long period of time. And so that may be, something that you need to record. And it kind of looks like, yeah, they, got into something and they've paid it down, right? They've just made their normal lease payments probably over those years. And so that outstanding balance that they're mandated to pay, it's kind of what it looks like. Okay, again, you might have to take a look at that. So that's one thing on the balance sheet that does kind of jump out at me a little bit. Their common stock, not too much. Additional paid-in capital, that would be some additional shares that they had sold along the way. They do that a little bit, but that might also include the compensation, the stock-based compensation that they give, because it's not a ton that's going on there. Retained earnings, nice. That's just what they've retained every year, that they didn't pay out in dividends. Okay, they didn't pay out in buying back stock. Okay, comprehensive income and other, those, who knows, it's not a big number, and so we don't probably need to take a hard look at that. Probably don't. So total common equity, their common equity has increased from 940 up to 1.5 billion dollars. Again, that's their total equity. Okay, so that would be their book value, is 1.5 billion dollars. What's their market cap? Anybody got that up so I don't have to switch here? I can probably switch. I'll look at the summary, see if it tells me. Market cap, 9.63 billion. Okay. That's what we as investors think that Decker's worth, but their book value is only 1.5 billion, right? Right. Basically it. Yep. Okay. So that's why there's that huge, oftentimes a huge difference. And that one may look big with Decker. Believe me, some of you will look at your companies and the difference will even be way more outstanding than that. Way more outstanding than that. Why do we think that the market? Again, it's our assumption as investors on their future cash flows, what they're going to make on into the future. Okay, book value is just those assets, basically that you've bought and that you have, or the cash and those types of things that you have on hand, right? Minus your liabilities. Okay, you take a company like Apple. They don't need a whole lot of assets to operate, not that much, okay? They've got a lot of cash on hand and investments and whatnot, Apple does. But, so their, their book value, I'll bet you compared to their market value is just tiny, right? Okay, so I'm gonna go back, balance sheet, sorry, let me go take a look at this. I like it on the left, you guys might like it on the right. I was gonna see if we had some of their stock stuff. Total shares outstanding, again, you can see where that's kind of gone down. Tangible book value, again, tangible, yeah. What's that? Over here in their last report, their last quarterly report, it dropped big time. My guess is they probably got caught up a little bit on their accounts payable and stuff in the trailing 12 months. We'd have to go up and take a look, but full-time employees gives you a few other things there. Nothing there that's that major. But if we look at the cash flow, then lastly, let's try to look at it kind of quickly. So you got income, and then you got adjustments to cash flow, right? Depreciation adds back in, right? Okay, amortization of goodwill and intangibles adds back in a little bit. Remember on the balance sheet, we saw that you had the goodwill, and that stayed at 14, 14, 14. But we had the intangibles, and those were going down a little bit. That's what's going on there. They're amortizing those intangibles a little bit. Amortization is the same as depreciation, basically. It's just you depreciate physical assets, you amortize non-physical assets. That's, again, probably an oversimplification of that, but for our purposes, it should be okay. So we just take a look at these. Here's that, I talked about stock-based compensation being a part, and that may be, the shares, we saw on the last report. What the heck was that? On the balance sheet at the bottom in the equity, there was something that talked about the shares kind of going up a little bit, even though they're buying back stock, and that would be this right here. Other operating activities, a big jump here, change in accounts receivable. No, we know what that is. That's just increase in sales. Change in inventories. Why is that a negative number on the cash flow? Okay, and why is that a negative number on the cash flows? Well, because anytime your inventories go up, you're basically expending cash, right? So this is just saying that that's a negative to cash, and we saw that with our increase in inventories. Again, this ties these two statements kind of together, okay? Changes in accounts payable, that's a positive to cash because our accounts payable have actually gone up, meaning that we're delaying the payment, okay? Changes in income tax, et cetera, et cetera. So cash from operations, look at that, it took a big dive there, actually. Okay, from operations, what was the big dive? Again, it's the increase in the inventories and the increase in the accounts receivable. There's other little things, obviously, that contributed to that, but their net income was up. So it was. Yep. Yep, you bet. Because as your inventories go up, normally you would expend cash for that, right? Okay, and so as your inventories go up, your cash is depleted. As your accounts receivable goes up, it means people aren't paying you as timely, right? So if I'm allowing you to wait 30 or 40 days or 50 days to pay me, okay, I'm short of cash. And so that causes my cash to decrease. Does that make sense? Now in the accounts payable, it's the opposite, right? I'm delaying what I'm paying my suppliers. So the net effect on my cash is an increase in cash. And all these things, filter out, they net out. Okay, and that's why we end up with this big drop. But it's mainly because our accounts receivable and our inventories have increased quite a bit. Okay, if we go back and look at that. So capital expenditures, not a lot. Not a lot going on there. And that kind of makes sense that, geez, they're not buying or selling property and plant, right? They entered into some capital leases, it looks like. That doesn't affect cash, right? So that's one of those things that's a little bit weird. Short-term debt issued, look at that. They used to issue some short-term debt, but now they don't issue any short-term debt. Why do they say issued? Most big companies issue bonds and whatnot, as opposed to going to the bank. Okay. Short-term debt repaid, look at that, man. I mean, they got no debt, okay? Now that's, when I say they have no debt, I'm not talking about their accounts payable and those types of things, because there is, and you got taxes, deferred taxes and things like that are always going to show up on your balance sheet. Okay. Look at that though, repurchase of common stock. boom, 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 and a huge jump this past year in the repurchase of the common stock. So, they've been buying back their stock pretty aggressively, and that's depleted their cash then, okay? But even so, I say it's depleting their cash, and their cash from operations has decreased dramatically. It's still very positive, right? So it's still a cumulative thing, kind of. We're still doing pretty good on the cash side. We just didn't increase it as much. Okay, and our net change in cash here though was negative this past year, but that's largely because we bought back so much stock. We just, as Decker, we just decided we had a lot of cash on hand, and we did. Stock prices came down. I'll bet you if we looked at that chart again, we could see where their stock prices came down, and Decker said, "This is a hell of a time to buy back some stock. We got all this cash sitting here." Again, I'm kind of guessing, but I bet that's what they did, right? Okay. And some of these other ones are just, they're kind of cool to look at, and some of that might jump out, but does that kind of give you an idea again? And I'll look at everybody's company probably before the end of the semester, and we'll go through kind of a similar thing. But hopefully, even if I'm going through Bridgers, you guys can look at your own company and say, "Oh, I see what's going on there. There's something going on." I can spot these things, and you'll hear me up here speculate about what's going on until I open up that annual report and read about it. Okay, I'm not going to know what's actually going on. Okay, when you get to one that's this is why I want you guys to really get into this research now, because when you get to one that's a little bit weird, like I told you, is that on the balance sheet, the effect of the taxes, what the heck was that one? I can't even remember what it's called. And I told you it was the difference between the SEC and the IRS. Deferred tax assets. They don't have much going on here, so that's fine. But some of you guys might find a big one there. You won't probably, Colin. You're a UAL, right? You may not either. Yeah, you probably won't have a big effect there. She may. She's Lockheed Martin, and so that could have a big deal. Generally, what that is that when a car manufacturer makes cars, okay, they know that they're going to have a certain percentage of recalls. Okay, they just know that through experience. Let's say it's 5% of recalls, right? Okay, so the SEC requires that they put that 5% on their report. Okay, so if I made $100 million in cars, I got to put $5 million as basically an expense that's going to be on my report. But guess what? The IRS doesn't let me write that off, okay, unless and until it occurs. But when it occurs, I get to write it off, and so in the future, I've got a deferred tax asset is what that amounts to, based on that I'm going to get to write off in the future on my SEC report, which is what we're looking at. And so it gets, yeah. Hopefully I got you guys totally confused right there. So in your deferred tax asset, you're probably going to see in your company, you might see a big number here on this deferred tax asset change. And if you get to that, then we'll have a discussion about that, because it gets to be kind of confusing. Okay, I'm going to quit. Let you guys get to work on that, do some research on your companies.